The moment that investors have been waiting for is likely here, and it's also likely priced into the stock market. On Thursday, September 18th, it is expected that the Federal Reserve will announce their first rate cut since December of 2024. But here we are again. How do we prepare? And in today's video, we're going to be talking about how to prepare our portfolios, which sectors tend to perform better when rate cuts start, and I'm also going to give you guys some ideas on some investments to make with interest rates coming down. So make sure you stay tuned throughout the entirety of today's video, and to show your appreciation, just simply click that like button down below. I appreciate it, and it definitely helps with the growth of this channel, and make sure you're subscribed so you're notified anytime we drop new content. And with that being said, let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump straight into today's video because we have a jam-packed week with the Fed meeting, which starts on Wednesday, the two-day meeting, which I believe is going to conclude in a 25 basis point cut that's going to be announced on Thursday, the 18th. I'm sure we'll have some dissents from the committee on whether now is the time or whether we should do 50 basis points, so don't be surprised by that. However, this is also the most anticipated rate cut in modern history, so no investor should be caught off guard by the news. The current FedWatch tool is placing a near 96% probability of a 25 basis point rate cut on Thursday, and the remaining 4% is expecting a 50 basis point rate cut. I'm in the 25 basis point camp, and I've been talking about that pretty openly on my weekly live shows this year. Remember, when it comes to the Federal Reserve, they have a dual mandate in order to keep inflation in check, and the other is to keep full employment when it comes to the labor force. Well, as we have seen over the past few months, inflation has come down meaningfully from near 10% a few years ago to hovering between 2.5% to 3% in terms of CPI this year. The Fed aims to keep things closer to the 2% level, which we have not seen since the start of 2021, before things completely got out of hand. So we do have things under control, and we're in a much better situation than we were just a few years ago. But one could argue, if they were diving deeper into CPI and inflation, that things like Supercore are starting to show inflationary tactics, and they wouldn't be wrong. However, when we turn to the other side of the dual mandate and look at the labor market, things are definitely starting to look pretty weak there. Again, they're not falling off a cliff. I'm not calling for a recession, but there's definitely some warning shots that are being shown. Looking deeper at the labor market, we could see that unemployment rate has risen from around 4% a year ago to 4.3% today, and it continues to trend higher. Job creation has also come to a halt, with the month of June actually showing job loss of 13,000 jobs. And wage growth is falling as well to the lowest levels in more than a year at 3.7% for the month of August. All of this points to a workforce in decline. When it comes to the economy, we are a consumer economy. 2/3 of GDP here in the US is all based on consumer spending. But if consumers don't have jobs, they don't get paid. If they don't get paid, they don't have money to spend. If they don't have money to spend, businesses don't make money and thus cut jobs. It's a revolving door. So yes, in my opinion, I do in fact believe that the Fed should start cutting rates. Do I believe 50 basis points? No. Why should we be in a hurry right now? So now we're going to turn our attention in this video and start talking about sectors. Which sectors are going to perform better now that interest rates start to come down? And given the fact that this is the most anticipated rate cut in modern history, I believe that we could in fact see a bit of a pop, but after that, it's going to be a sell the news environment for me. And again, that's just my opinion. This shouldn't surprise any investor. But when it actually happens, there are going to be some retail type investors that will get excited, and I believe the money managers are going to sell right into that excitement very soon. When we think about where we're at right now from an investing standpoint, we have the stock market sitting at record levels. We have gold sitting at record levels. We have yields that are starting to come down, meaning there's a lot of investors moving into more short-term treasuries. And we have an S&P 500 that's sitting at a valuation at the highest levels in more than 5 years outside of the pandemic market we have, meaning it's the highest levels since the dot-com bubble. On a forward-looking basis, we're sitting with an S&P 500 currently at 23.5 times, which is below the 24.4 times we saw in December of 24 and 24.3 times we saw in January of 2022, but otherwise very elevated considering the 10-year average is only around 19 times. So what am I doing with my portfolio? And again, I continue to preach on this channel that we never try to time the market. Just because I believe the market could in fact come down doesn't mean I'm selling out of it and going full boat into cash. No, but we can rearrange our portfolio. We can lower our weighting towards high growth, and we can increase our weighting towards more defensive sectors, more value sectors. So when it comes to sectors, which sectors are going to benefit most from lowering interest rates? The thing that needs to go through our head is which companies are going to benefit from lowering borrowing costs. And the first thing that pops into my head is going to be real estate or real estate investment trusts. But that's not all. It could be home builders. It could be material companies. It could in fact be home improvement companies, etc. Real estate bouncing back has a full trickle-down effect. That is great for the economy. Lower borrowing costs get more home buyers in the market. More home buyers mean more home demands. More home demands mean more materials. More home transactions, more improvements, so on and so forth. So before we get into some actual investment ideas, let's talk about short-term, medium-term expectations. We've been touching a lot on what my expectations are over the course of the next 30 days. I think there could be a rough patch that we could potentially hit here. Again, gold prices at record highs, S&P 500 valuation high, S&P 500 record levels, so on and so forth. There's plenty of things pointing towards a necessary pullback. So yes, in the next 30 days, I am pessimistic. But over the medium term, through the end of the year on, I'm still optimistic, and that's why I want to stay invested. But it doesn't mean I don't have moving parts within my portfolio. And if you're interested in tracking my entire portfolio, getting trade alerts for any stocks I'm buying or selling or ETFs, then consider subscribing to the Stock Investor's Edge and become an Edge Plus subscriber. You will get all of those alerts and so much more. So over the course of the medium term, why am I optimistic? One of the reasons have to do with $7 trillion of cash. That's 7 trillion with a T of cash that's sitting on the sidelines. 7 trillion has been enjoying this high rate environment of risk-free money and good yields. However, with many yields that are connected to CDs and risk-free accounts, savings accounts, and things like that, they follow the Fed funds rate. And with the Fed funds rate starting to come down, that's going to bring all of those yield, those cash yield accounts down with them. So $7 trillion on the sideline. Again, all of that money is not going to come into risk on assets like stocks, but even if we got a small portion of that, that could be enough to fund a nice size rally into the end of the year. So now that we've gone through all of that, let's talk about some actual actionable ideas. And again, earlier I talked about sectors that are going to benefit, and the most obvious one is going to be the real estate sector, particularly real estate investment trusts, because of the way that they are set up. They are required to push out 90% of their taxable income to shareholders in the form of dividends. So these types of companies do in fact rely a lot more heavily on debt. And with borrowing costs coming down, that's going to benefit the REIT sector. So the first two that we're going to talk about today, investment ideas, are both going to be REITs, with the first one being Vici Properties, stock ticker VICI. And this happens to be my largest REIT holding, and they happen to be the largest landlord on the Las Vegas Strip. They have fantastic, high-quality properties. Just talking about Las Vegas, they own the likes of Caesars Palace, MGM Grand, Park MGM, Mandalay Bay, the Mirage, and so much more. During the pandemic, REITs got absolutely crushed because many of their tenants were unable to pay their rent. Even the likes of Realty Income, which is known as the gold standard of REITs, they saw their cash collection drop down below 60%. Vici Properties was one of the only REITs to have a 100% cash collection during the pandemic, and they still have it today. That speaks to the quality of this company's tenants. The company currently has a market cap of $35 billion. Over the past 12 months, shares of Vici are up 2%. However, year to date, the stock is up 14%. Regardless of how poor the REIT's stock price has performed over the past 12 months or even over the past few years, it's important to also look at their financial performance because you can see varying differences. And this is how we find undervalued stocks. When looking at this Fiscal AI chart, which is the platform I use to research every single stock and ETF that I buy before I buy it, and you can utilize it free with their 2-week trial using my link down in the description below and get yourself 15% off as well. But as we can see here with Vici, revenues are at an all-time high at $3.9 billion, and AFFO is also at an all-time high at $2.76 billion. From a valuation perspective, shares of Vici currently trade at a forward price to AFFO of just 13.8 times, which is in line with the company's 5-year average. But with lower borrowing costs on the way, this could spur more profitability, which makes this stock that much more intriguing. In addition, given the assets they own and the quality of the tenants, this is a REIT that should be trading closer to 16 times based on my opinion alone. And that's going to lead us to the second REIT we're talking about, which is going to be Equinix, stock ticker EQIX. And when it comes to Equinix, they are one of the largest REITs by market cap, and they are the single largest REIT when it comes to data center REITs. And when hearing about the AI boom over the past few years, how many times have you heard the words data centers? There's huge demand, and this company has a long runway of growth. The company currently has a market cap of $77 billion. Over the past 12 months, though, shares are down 9%. However, year to date, the stock is down 16%. So now might be a great time to get into this REIT because it has catching up to do. It has plenty of growth moving forward. And as we're going to see here in a second, the valuation looks great. When looking back at Fiscal.ai, we can see that the company's revenues are, again, at all-time highs, $8.9 billion. And on top of that, AFFO continues to climb higher at its own all-time high of $3.6 billion. From a valuation perspective, shares of EQIX are looking rather intriguing, as they currently trade at a forward price to AFFO of 20.2 times, which is well below the company's 5-year average of 24.2 times. This is a company with clear growth and trading at a great valuation. The last investment I'm going to give you is actually an ETF that's focused on small caps. And that ETF is going to be IJR, or the iShares Small Cap ETF. And when we're talking about small cap, the most popular ETF out there is IWM. But by investing in IWM, you are investing in over 2,000 companies. That's too broad for me. There's a lot of companies that are poorly managed, not all that intriguing, aren't growing, and thus they're small for a reason. And when it comes to me gaining exposure to small caps, I want to invest in the highest quality, companies that are showing growth, companies that are on their way to becoming mid caps. That's what IJR does. The ETF currently has $85 billion in assets under management, and it's up 2% over the past 12 months. However, in the last 3 months alone, shares have climbed 11% since the talk of rate cuts moved towards a reality. Here's a look at the ETF's top 10 holdings, which account for only 7% of the ETF. And in total, IJR has a little more than 600 holdings. REITs benefit from lowering borrowing costs, and small caps benefit from lowering borrowing costs. 2 areas I believe could end the year much higher than where they're at here today. So there we just went through my thoughts on the projected rate cuts that are going to be starting this week, the sectors to look for, and some investment ideas. Down in the comment section below, let me know what are your thoughts on these ones here, and how many rate cuts do you believe we will have from right now until the end of the year, including the September rate cut. Thanks again for watching, and if you haven't done so, please show your appreciation by just simply clicking that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.